Most traders don't lose because they are wrong. They lose because they are right for a few minutes, then panic. That panic is the habit of closing winning trades too early, and it is one of the most expensive behaviors in retail trading because it kills the only thing that can ever make you profitable long term: expansion. You can survive bad entries. You can survive losses. You can survive drawdown. You cannot survive cutting winners short. The market pays very few trades. When it pays big. And the trader who exits early is the trader who funds the one who stayed. This is not motivational talk. This is market mechanics. Institutions do not need to be right often. They need one expansion to compensate for multiple small losses. Retail traders never allow that expansion to happen because the moment price moves in their favor, fear takes over, and fear wears a disguise. That disguise is called locking profits. Let's be honest, most traders are not locking profits. They are running from uncertainty. The moment a trade goes green, the mind shifts from execution to protection. The trader stops thinking about objectives and starts thinking about not losing what they just gained. That shift is fatal because the market does not reward protection. It rewards exposure aligned with intent. Now understand this clearly. A trade that goes 10 pips in your favor has done nothing meaningful. A trade that goes 20 pips in your favor has still done nothing meaningful. Expansion begins only after liquidity objectives are engaged, but retail traders exit before liquidity is even touched. Why? Because they confuse movement with completion. Price moving is not the same as price fulfilling purpose. The market does not move randomly. It moves toward pools of liquidity. Equal highs, equal lows, previous session highs, previous session lows, higher time frame inefficiencies. Professionals hold trades until those objectives are met or invalidated. Retail traders exit when they feel relief. Relief is not a trading signal. Now here is the uncomfortable truth. If you are emotionally attached to unrealized profit, your position size is wrong or your understanding is incomplete. Professionals do not celebrate early green. They remain neutral. They know the real test comes later, when price retraces, consolidates, or manipulates before expansion. Retail traders celebrate early green because they don't trust continuation. That lack of trust comes from experience. Most traders have never held a real runner. They have never experienced what happens when price expands cleanly for hours or days. So they don't believe it will happen for them. So they take what the market gives early and leave. Then they watch price run without them. Then they feel regret. Then they repeat the cycle. This is the emotional loop that keeps traders trapped for years. Now let's talk about why the market punishes early exits. Markets are auctions. Large players need participation from smaller players to distribute positions. Early exits provide liquidity. Every time you close early, you help price move further without you. That is not poetic language. That is how order flow works. You exit your long early. Your sell order helps fill buy-side demand. Price continues higher. You are out. Institutions stay in. That is the transfer. Now consider this. If you cut winners early but allow losers to hit full stops, your expectancy is already broken. No strategy survives that behavior. Even a mediocre strategy becomes profitable if winners are allowed to expand. Even a great strategy becomes unprofitable if winners are clipped. So the issue is not your model. The issue is your management. Now here's where the ICT perspective matters. ICT is not about perfect entries. It is about precision narratives and patience through manipulation. The market often gives profit early to test your discipline. That early green is not a gift. It is bait. The market asks one question. Will you stay or will you fold? Most traders fold. They fold because they are trained to believe that profits must be protected immediately. They have been conditioned by social media, screenshots, and low time frame scalping culture. Professionals think differently. They ask, has price done what it came here to do? If the answer is no, they stay. They do not care about unrealized profit. They care about objective fulfillment. Now let's talk about partials, because this is another area of confusion. Taking partial profits is not wrong. Taking partial profits too early is. Most traders take partials at arbitrary levels, round numbers, fixed pip targets, Small structure points that mean nothing on the higher time frame. Professionals take partials where reactions are expected, not where they feel comfortable. That means previous highs and lows, session levels, higher time frame imbalance, liquidity pools. If you don't know where reactions are expected, you have no business managing trades dynamically. Now hear this carefully. The market is not obligated to give you comfort before expansion. In fact, it usually does the opposite. Price will often move in your favor, pull back, consolidate, and then expand. Traders who exit at the first push never experience the real move. They think the market is cruel. It's not cruel. It's efficient. Now let's address the psychology directly. Closing winners early is rooted in a scarcity mindset. The trader believes opportunities are rare, so they grab what they can when they can. Professionals believe opportunities are constant, but expansion is rare. So when expansion is available, they do not waste it. That mindset difference is everything. You don't get paid for being green briefly. You get paid for staying aligned when others lose patience. And patience is not passive. Patience is an active decision to endure uncertainty for greater reward. Most traders confuse patience with inaction. That's wrong. Patience is controlled exposure. Now here's the final truth of this chapter. If you are not allowing at least some trades to run far beyond what feels comfortable, you are not trading professionally. You are trading emotionally. The market does not care how long you waited for the setup. It only pays those who stay through the uncomfortable middle. And the uncomfortable middle is where most traders exit. That is why most traders never break out. The fear of giving back profits is stronger than the fear of taking a loss. That single truth explains why most traders never allow a trade to mature. Losses are familiar. Losses are expected. Losses are part of the narrative. Traders accept early. But profits feel rare, fragile, and temporary. The moment a trade turns green, the mind shifts from execution to defense. That shift is poison because once you start defending unrealized profit, you stop trading the market and start trading your emotions. The market does not move in straight lines. It expands, retraces, pauses, and manipulates. If you interpret every pullback as a threat to your profit, you will never hold a position long enough to capture expansion. Now let's say this clearly. Giving back profit is not failure. Giving up on structure is. Professionals expect retracements. They expect profit to fluctuate. They do not equate pullbacks with danger unless structure is actually violated. Retail traders equate red candles with danger, regardless of context. That's why they exit. Now understand where this fear really comes from. It comes from small wins. When a trader's average win is small, every profit feels precious. There is no cushion. There is no confidence. There is no statistical backing. So they protect aggressively, but that protection ensures the average win never grows. This creates a feedback loop. Small wins create fear. Fear creates early exits. Early exits keep wins small, and the cycle repeats. Professional traders break this cycle by allowing some trades to do all the work. They do not expect every trade to be a winner. They expect a few trades to matter. That expectation changes behavior. Now, let's talk about drawdown inside winning trades. Most traders cannot tolerate a winning trade going back toward entry. They feel cheated. They feel like the market is taking something from them. But the market never gave you anything until you closed the trade. Unrealized profit is not money. It is potential, and potential fluctuates. Professionals do not anchor emotionally to unrealized profit. They anchor to structure. As long as structure remains intact, profit fluctuation is irrelevant. Retail traders anchor to profit and loss. That is why they feel every tick. Now here is the brutal truth. If you cannot watch a winning trade retrace without interference, you are not trading ideas. You are trading hope. Hope is unstable. Ideas are structured. Now let's talk about confirmation bias, because this fear is deeply tied to it. When a trader is in profit, they start looking for reasons to exit. Every opposing candle becomes evidence. Every pause becomes a warning. They selectively see information that justifies closing. This is not analysis. This is fear. Looking for permission. Professionals do the opposite. They look for reasons to stay until the idea is invalidated. They do not fear losing profit. They fear exiting before the market finishes what it started. That difference is discipline. Now understand this. The market often retraces just enough to force emotional exits before expansion. That retracement is not random. It is engineered. Price needs liquidity to continue. Early exiters provide that liquidity. If you cannot sit through that retracement, you are not positioned for expansion. You are positioned to fund it. Now let's talk about trailing stops, because many traders think this solves the problem. Trailing stops do not fix fear. They hide it. Blind trailing creates the illusion of discipline while still capping expansion. Professionals trail stops based on structure, not comfort. They trail behind protected higher lows. They trail only when price has shifted behavior. Retail traders trail behind every green candle. That is not management. That is panic automation.